Hello and welcome to the ETF Show, taped here at Asset TV Studios in New York. I'm your host, Kristen Myers, ETF Editor-in-Chief at Asset TV. Now, 2025 saw a record number of inflows into U.S. ETFs, $1.5 trillion to be exact, and that's a healthy increase from the $1.1 trillion of inflows into the space in 2024. But we are at the start of a new year, and if last year was any indication, this year could also set records. So here to discuss where ETFs are going next, we're joined now by Scott Dennis, head of ETFs for TCW. Scott, thanks so much for joining us today.
Thanks for having me.
So we just mentioned some of those numbers for 2025, and you had actually said that 2025 was the year that ETFs became more complex. How so?
I think 2025 was a tremendous year. Obviously, as you said, record year. I think what we're seeing is sort of this secular shift away from, not away, you're still seeing a lot of assets pouring into the passive side of the space, but in 2025, we really saw a growth of active ETFs. So fundamental, relative value, stock picking, bond picking. I really think that's just the market is quite volatile. It's a lot of uncertainty, so investors are demanding active over passive. At least that's what the data showed in ETFs in 2025.
Does anything feel a little bit different now as we enter into 2026 from last year, or is it just a continuation of some of those trends?
I think the momentum is there. I think we'll see a continuation of those trends. I mean, yesterday was a great example. Bonds sold off, U.S. equity sold off, U.S. dollar sold off. So just, again, a lot of volatility. A lot of uncertainty. We had obviously the administration in Davos on TV this morning, and the market turned. So we're going to, I think, continue to see the market trading around news, trading around headlines, waiting for new data to come out. And active ETFs are a great spot to be in when the markets are quite volatile as they are.
Okay, so on the point of active, because I have another data point here, more than 30% of all ETF inflows in 2025 went to actively managed strategies. What was the reason behind that huge growth, specifically in the active space?
I think it's the market, as I said before. We're seeing investors demanding ETFs and demanding, at least last year, in terms of new flows that came into the marketplace. Active flows actually doubled up in terms of what passive flows were in 2025. So investors are looking for an ETF wrapper. They're looking for an active ETF wrapper that allows them to trade around and invest around news in volatile markets. ETFs, you can trade them intraday. They're transparent. And in an active space, you can rotate different sectors and fixed income. You can go short duration, long duration, and the portfolios can kind of change. They're not necessarily tied to an index as you would see in the passive space.
So for any financial advisor that might be watching, as you mentioned, passive is still outshining active in terms of the total inflows. But how should an advisor or an investor really think about those active strategies in their portfolio alongside some of those passive plays that they are making?
Yeah, I think there's definitely spots for passive investing. And as you said, still 89% of assets are in ETFs or in the passive space. We're just seeing a lot of growth in active. We actually saw double the assets come in active last year. At TCW, we believe there's two specific areas for active, and we're seeing this from investors, is on the equity thematic side. So we have some exposures in artificial intelligence, supply chain, and one of our most popular powered PWRD is on energy transition. On the fixed income side, kind of going back to what I said before, is that you're certainly seeing some passive interest in sort of your benchmark hugging, your large ag exposures. But people are investors, retail investors, wealth investors are looking to invest in active spaces. So in something on the fixed income side, an unconstrained fund like our fund Flex or FLXR was very popular last year, actually almost grew by five times its assets in 1 year. Allows our portfolio management team to make relative value decisions based upon what's happening in the market. For example, we're underweight credit right now. It's just there's been a really big, credit has been very popular, credit spreads are extremely tight, so we are actually overweight securitized markets where we feel that it's still high quality and you're still generating good yields. So from a relative value perspective, we're able to pivot and move into an active platform and provide value, risk-adjusted returns with good carry and good yield.
Okay, so I'm glad you mentioned fixed income, and I will ask about the thematics in just a second. But for fixed income, I mean, Fed moves were really top of mind in 2025. I think they still remain very much top of mind for 2026. Now, when we looked at active fixed income specifically, $164 billion went into actively managed fixed income funds. You mentioned just a little bit some of the flexibility that you have, especially with your fund, FLXR, that gives the investors that active managed almost edge and boost. But I'm curious to know, is it the complexity of the space when we're looking at fixed income that is really driving so much of that growth and those inflows into actively managed fixed income? Why are we seeing investors really gravitating towards active management, specifically when we are looking at bonds and at credit?
Yeah, I mean, it really goes back to what's happening in the markets. There's a lot of geopolitical risk out there. Inflation seems to be under control, but is certainly a prevalent aspect in terms of investor decisions, particularly on the TCW side and active. I wouldn't say it's more complex. I would say that the industry investors are moving towards wanting the ability to generate alpha in this current environment. And with the volatility and uncertainty, who knows what headline is going to come through, they feel that they're giving their money, their assets to an advisor to TCW that's able to actively manage that and sort of pivot our strategy to generate alpha in different scenarios.
So on thematics. So you said that energy transformation is redefining the global economy, or TCW has said that,
Yes.
Especially about this energy thematic. What makes energy so compelling in 2026, do you think?
Well, there's a lot of money coming into the energy space. If you take a look at the backdrop here, the US, the world is going to need more energy, whether that's in AI, whether that's in building factories from a reshoring perspective, whether it's just a transformation into more of an electronic or electrified economy. And over the past several years, there's been a significant amount of increase into the energy space. Grid needs to be changed. Going forward through 2030, we expect that capital investment into energy to more than double. So Powered, as you mentioned, which is our energy transformation ETF, isn't just investing in energy companies. It's taking a look at a broad swath of different industries within the energy space, whether that's industrials, whether that's cooling for AI, and picking stocks from a fundamental high conviction perspective that we feel are going to benefit from this energy transition, where more and more money is coming into the space. And quite honestly, we're going to need more energy going forward for computing and a variety of different things.
Now, when you were talking a second ago about FLXR, right? You mentioned the capacity, because it is an actively managed fund, to be able to pivot, especially at such a time when, as you mentioned, credit spreads are very thin.
Yeah.
Rate cut moves we're still unsure. Investors are a little unsure about what's really going to be truly happening with the Fed this year. They're going to be losing Jay Powell halfway through the year. But when it comes to this energy, transformation theme, as you're mentioning, Powered, it is an actively managed fund. What do you think that sort of edge there, that active management really gives, particularly for this space?
Well, again, I think TCW's active approach in terms of relative value, high conviction, is a differentiator in the industry. Our performance in 2025 spoke for itself. For example, Powered was the 9th best performing ETF in all of 2025. It had 34% returns. So from its category, it was top of the list. So clearly, we're doing a great job in terms of picking the right stocks in the energy transition. And we feel like that's only the beginning. We feel that this is going to continue. Assets in that grew three times in 2025. And this year alone, we've already taken in a pretty large chunk of money, totaling about $50 million. So the momentum is there. I don't think we're going to have any different stories in 2026 than we did in 2025 in the energy space. But if we do, because it's active, we can pivot. And we can rotate into different securities, different industries, as we feel that our active strategies are going to be able to generate the most alpha.
So looking back now again to 2026, curious to know what innovations you're really seeing in the ETF space for 2026. Are they adding complexity, some of these innovations, or do you think they're adding value, or is it a both sort of scenario?
I think there's two ways to answer that. First, from a regulatory or structural perspective, the innovation in 2026 is going to be ETF share classes and mutual funds. So in November, the SEC granted exemptive relief to do that. TCW filed, and we got a permission, we got approval to do that just last week on January 13th, I believe the date that was. So going forward this year, I think a lot of issuers are going to be reevaluating their lineup. ETFs clearly are setting records in terms of inflows.
Right.
And a lot of issuers are like, okay, this is a good space to go to because investors are demanding transparency, intraday liquidity, and tax efficiency. So I think this year going forward, we're going to see more issuers taking a close look at having ETF share classes of mutual funds. that gives firms like TCW flexibility to take a mutual fund that's been around for 10 years with a great track record, great returns, and actually hang an ETF share class off of that, not going out having to find seed, and really having that track record that our investors are already invested in and loving. They just want a different wrapper, again, for those same reasons, whether it's tax efficiency. I think the second thing we're spending a lot of time on at TCW is taking a look at digital assets. NYSE came out, I think it was last week, and then NASDAQ earlier last year in terms of tokenization of ETFs, tokenization of securities. We're taking a very close look at that. We think that's a huge area of growth, not just for ETFs, but just for the industry. So we're kind of getting our ducks in a row, taking a look at the technology side, and I would expect to see us, if the industry does move forward with tokenization of ETFs, we'll be right there leading the charge with it.
So on the ETF share classes, it was a huge headline all throughout 2025 that ETF share classes were coming.
Yeah.
Can you describe what change that actually might mean for investors?
Yeah.
Do they need to temper any expectations when it comes to ETF share classes at all?
Yeah. Well, first of all, just to level set, it provides more choice to the end investor. This is a great thing for the industry. But to your point, I think it's going to be a slow progress in terms of assets moving into these. They're still new. Well, share classes aren't a new thing. They've been around for quite some time. It's just the rest of the industry is now going to have it. So the choice of wrapper. So as a wealth investor, I can choose to maybe put money into a mutual fund, which is good for retirement, or maybe I want tax efficiency or transparency, and then I move into an ETF. But the transition to that and investors getting used to a share class of a mutual fund is going to take time. I spend a lot of time with investors. I travel throughout the country, throughout the world. I meet a lot with the wealth platforms. There's a lot of technology that needs to be built and a lot of changes that need to take place in order for them to implement that. So the reason I say that is I think we might see a lot of new active ETFs off of mutual funds, but I'm not necessarily convinced we're going to see a huge asset influx. I think that's probably a 2027 or maybe beyond, as a lot of these platforms, which are the huge buyers of ETFs, sort of get their technology and get their comfort level and the regulatory side figured out.
All right, so I want to talk again about Flexer. Talked a lot about these two funds, but looking at TCW specifically, so your assets more than doubled in 2025. Which is huge.
Thank you.
What do you think this says about the way investors are really using, your ETFs and especially your strategies, like Flexer, like the flexible income strategy? Yeah,
I think people are investing in Flexer because a lot of different reasons. I think that the three main ones are risk control. So you're buying a fixed income product that gives you preservation of capital. So we're take a very close look at preservation of capital and risk returns. Secondly, the flexibility. As I mentioned before, credit's very tight. So if you're in a beta vehicle or in a credit manager, you're probably not earning as much yield for that high quality of investment. So in steps the relative value conversation. So if you take a look at something like Flexer, it's overweight in the securitized side of the business. Still very high quality, but from a relative value perspective, you're still earning really good yield and really good carry. And I think the third reason is just duration control. As for example, yesterday was a big sell-off in rates. If you take a look at something like Flexer, we didn't go up, but we didn't go down as much as the rest of the industry because we're able to control that duration perspective. So right now we're actually shorter duration than the benchmark. We're kind of sitting in that area where we're getting good yield, but we're also positioned for potential Fed cuts, potentially two Fed cuts in 2026. So we benefit from that. But while we're waiting, and we think that rate cut cycle is going to be a relatively gradual, obviously dependent upon what's happening in the market, but it's, goes slowly. We still have good carry. If Fed cuts, we're in the short end of the curve, so we benefit that from an alpha perspective.
So let's end with a little bit of portfolio guidance for everyone that's watching. So we were just talking obviously about the rate cuts and that path forward in 2026, but investors are also still saying valuations are high, market is incredibly expensive right now. What should investors really keep in mind as they are positioning their portfolios for 2026?
Yeah, I mean, I think 2026 is going to be a lot like 2025, again, characterized by high volatility. I think investors need to be smart about where they're putting their money, and I think they should really think about the active space, because we don't necessarily know what's going to happen in 2026 in terms of Fed cuts, in terms of news coming out of Washington, in terms of decisions and what's going to happen geopolitically. So investors should be thinking about, how can I pivot my portfolio very quickly? I think the other important thing is taxes. We've had a huge run up in equities and in assets over the last 3 years. So a lot of folks are sitting on pretty big gains in their portfolio. And they think about going forward, if they feel that assets are going to continue to grow, they want a tax-efficient vehicle. ETFs have proven, both passive and in active, that they're tax-efficient, not throwing off capital gains. So kind of combination of really volatile markets, the ability to pivot around those markets with intraday liquidity, but at the same time being really sensitive about taxes, because that's really another important part of your returns going forward.
Scott Dennis, head of ETFs for TCW, thank you so much for joining us today.
Thank you for having me.
And thank you so much for tuning in to the ETF Show.